Hi, good morning, everyone. All right, so welcome to the Buy and Build panel. Today, we're lucky to have 5 incredibly successful leaders who achieved a ton of growth in their businesses through inorganic or acquisitive growth strategies. So to start the discussion, I'd like to go down the panel and have each panelist give a quick overview of the type of business they led, the length of tenure they had at that business in their role, and the number of acquisitions they completed during that tenure. So I'd like to start at the end with Mark.
Okay. You guys hear me okay? All right. My name's Mark Anderegg. I'm the chairman of Little Sprouts, which is a Boston-based provider of childcare services. We have 40-some odd locations throughout greater New England. I acquired the business through a search fund in 2012 and served as CEO until earlier this year. Acquisitions. We acquired about a dozen schools over the course of the 6 years that I was running the company.
Great. Jay?
Hi, everyone. I'm Jay Davis, former CEO of Vector Disease Control. We bought that business in 2011 through a traditional search fund. We sort of pivoted a couple of years into our deal and ended up in a very tangential related industry, which was pond and lake management. We managed water bodies to prevent unwanted plant growth. We did 14 acquisitions during our holding period, most of which were in pond and lake management. And in 2017, so just about 2 years ago, we sold the business to a company based in the UK, which is Rent-A-Kill. It's the largest pest control company in the world.
Thank you. Mike?
Hello, my name is Mike Rozenfeld. I'm the former CEO of Attainia. Attainia is a software business. We provide capital planning and budgeting solutions in the healthcare space, work with north of 110 large healthcare systems around the country. I bought the business through a search fund in 2016, and I served as CEO up until the summer of this year. We opted out to focus on organic growth during the ownership period, and I can talk more about the decision to focus on organic versus pursue acquisitive growth.
Great, thank you. Ryan?
Ryan Jones, currently CEO of Dynamic Growth Dental Support. We own and operate multiple dental practices under a few different brands in Pennsylvania. We're still in our early days compared to these gentlemen. I bought the business through the search fund model in 2018, and we just completed our 3rd tuck-in acquisition.
That's great. And Steve?
Good morning. My name is Steve Swinney, co-founder and CEO of Kodiak Building Partners. Kodiak was founded in 2011, kind of coming out of the housing downturn to acquire and operate building product distribution businesses. Over the course of the last 8 years, we've acquired 23 companies around the U.S., and we'll finish this year with about $1.3 billion in sales.
So to start off the conversation, the initial question I have is, looking back to your investment thesis, were you planning on an acquisitive growth strategy originally, or did that evolve over time? Steve?
Yeah, we definitely were. Our industry was one that had been really kind of gutted during the housing downturn. Really, most companies in the space were really pretty troubled at the time in 2011, and we thought an acquisition strategy was much more appropriate than introducing new competition to the space.
Got it. Ryan?
Acquisitions were always part of our growth strategy. I think what I've realized over the last year and a half is that there's significantly more organic growth opportunity within these acquisitions as well.
When we looked at Attainia back in 2016, like a typical search fund business that you guys are going to be looking at, a lot of things in the business were broken or non-existent at all. So when you don't have a structured sales organization, a marketing function, a number of other things that should drive organic growth, you believe that there is significant opportunity to put those things in place, and there's significant opportunity to drive organic growth above and beyond what has historically been shown in the business. And that's the reason you're able to acquire it, because you're typically acquiring a low growth business with absent middle management or not professionalized sales and marketing processes. So when we were looking at Attainia back in 2016 and putting together the investment thesis, the focus was to fix those things, to hire managers, to create a legitimate marketing function, and to put additional fuel into the sales and marketing engine to start generating growth in excess of what historically had been shown. So when we looked at the business, we did identify from the early stage a handful of potential acquisitions, but from the investment thesis, it was all based on organic growth.
Yeah, Michael, for us, it was not part of the original thesis. It really resulted from our shift into Pond Lake management. And once we ended up in that industry, it sort of became obvious that it was an attractive way for us to grow.
So it was also not a part of our original investment thesis, although in hindsight, one of the things we liked about the industry is that it was very fragmented. And really the rationale for focusing on organic growth in the investment thesis was largely a function of the fact that it's the way the company had been growing at the time we acquired it. But acquisitions really should have been central to it from the beginning.
So that's interesting. So, Mark, how did your acquisition strategy change over time from the first acquisition to the most recent?
I'd say the most comprehensive change was for us being in a consumer business, whether to rebrand or preserve the brand that we acquired. So we had some rather unpleasant experiences integrating businesses when we rebranded. We often had our customers say, kind of thanks but no thanks. I chose the childcare brand I chose for intentional reasons. So we pivoted, and thereafter we only rebranded distressed assets, and we preserved the brands that were flourishing at the time we bought them.
Jay, how did your strategy change over time?
Yeah, I think it relates to integration. I mean, we were very slow on purpose integrating our first few acquisitions. I think a lot can go wrong if you sort of force integration, and so we were very conservative about that. The challenge is you then can't scale an acquisition program if you're not integrating efficiently and effectively. And so over time, we became much more aggressive about integrating quickly. I think there's risk to that, but as the business grows, it's risk that you can absorb, and we had a much better team and all of that as well. So I think integrating more quickly would be the answer.
And Steve, when you started your investment thesis, you had an acquisition strategy in place, or you started with that in mind. How did your strategy evolve over time?
You know, I think the biggest thing that probably changed for us was after, I think it was our third acquisition. Prior to that, it was, we did the very traditional, very financially based diligence. Our third acquisition brought a very different culture into Kodiak than really what the rest of the business was, what we were about. It was an excruciating process for about a year of trying to figure that all out. And I think coming out of that, that was a real fundamental change for us, where culture and the evaluation of the culture and understanding what that target company looked like, how it would integrate with Kodiak, became really front and center for us. And frankly, the financial piece really all became secondary.
Ryan, you're in the midst of executing an acquisition strategy. Have you noticed a change between the first and the most recent, or is it still following a similar path?
All of our deals have looked a little different. We've had one seller that didn't roll any equity but stayed on. We've got one seller that's looking to transition more quickly. And we've got one that we think is just a really big organic growth opportunity. I think overall the changes that we've seen are internal changes on our priorities and what we're looking for in acquisitions. We knew the industry was highly fragmented and there was a lot of consolidation going on. So I think our thesis going in was going to be more of a roll-up, and what we recognized early on in operating the business is that there's actually a really big gap in terms of culture and well-managed businesses within the industry. And while a lot of people are going out and consolidating and rolling up a lot of practices, they're not doing a lot to add value or create true culture and build great businesses. So we've shifted our acquisition strategy to only looking at opportunities that we think have a really strong growth trajectory that we can really integrate into our culture and our systems. So we've shifted gears a little bit.
Got it. Mark, you came into an acquisition strategy along the way. What sort of structural changes did you determine were necessary inside the core business to support that? And did you make those changes before you made the first acquisition, or did you have to figure that out along the way?
That was a leading question. So no, we did not invest in the structure and the foundation that we needed before we started acquiring, which I think is a not totally uncommon mistake. So we actually got to the point where we developed an entire sort of integration team. Not everyone on the team was doing integration on a full-time basis, but we did have a full-time integration manager, which is a hire I wish I'd made much earlier. Just someone that can run point on making sure that folks are executing on the plan, and really, we called her the nag, which is not really the most flattering of titles, but just like making sure that folks are getting it done. So that's something that would have done earlier if I had it to do again.
Did she have multidisciplinary
Did she have a different name? Yes. No, sorry.
Was her discipline in multiple areas, or was she pulling in leaders from each area along the way?
Yeah, so it was very cross-functional. She happened to be a regional manager for us, so her background was in operating our school, so she already had sort of the cross-functional purview. But yeah, she drew from both school resources and kind of central corporate resources, and led a weekly meeting organizing those team members.
Jay, what sort of structural changes did you need to make to your platform as you started to acquire businesses?
Yeah, I was just hearing Mark talk, like doing this the whole time. So it'd be a lot of repeat, but it's all about the team. And just to dovetail with the integration conversation, we had a very similar structure where we had a dedicated integration team. These were functional leaders in our business, but it was very clear that part of their job description was integrating acquisitions, and that changed a lot during the course of the 7 years. We also had an integration leader who was just quarterbacking the process, and that person had essentially an M&A background.
Quarterback is a much more flattering name. I would just add one other thought, which is maybe obvious, but if you don't charge folks with integration being a core to their responsibility, it just feels like extra work. And I don't know, in my experience anyway, that can lead to a little bit of resistance if you don't, again, sort of make it known that integration is going to be a part of their day-to-day.
Sorry, but it's like the deal process becomes part of the culture. Like it's part of the culture of the business. And I think if you study a lot of the really great consolidations that have done a lot more deals than anybody on this panel, like that's just part of the business, and it's part of the culture.
Steve, is it a similar situation or experience for you? Is it part of the culture?
Yeah, definitely. Yeah, it's absolutely. It's something that our operators out in the field are always looking for and having conversations about potential targets. They get involved, as you guys talked about, really integration teams, deal teams, involve our operating people, involve our functional leaders at our corporate office. So yeah, it's definitely part of the culture.
So it's relatively easy to think through how you assess the objective criteria of an acquisition, the financials, the operations. How do you assess the cultural fit and whether or not it's a good, if it might poison the well overall? Steve?
Yeah, like I said, culture has kind of become one of the fundamental things for us. We don't really get too far before we assess whether the team and the leadership of that company is really the right fit for us. So it's like you do anything else. It's getting to know the people. It's spending time with them. It's spending time on their website and seeing what they promote and value in their company and what their actions are day to day. Because anyone can come into a management meeting, and if they've read up on your company, can tell you what you want to hear. But I think really spending time with them and then getting to know in other venues what they're about is what helps us.
Ryan, how far down the line do you interview or do you assess the people in the acquisitions? Are you looking primarily at the leadership, or do you go down to employee and functional level?
It's varied quite a bit. We have a lot of sellers that are very reluctant to give us access to their teams. They don't want it to be public information. They're afraid that their team members will leave if they find out that the business is being sold and that there are going to be changes coming through. And we didn't get access to some of the teams early on, and the initial acquisition had full access before there was even an LOI in place, which was great because it helped me really come in and build rapport. And then our first tuck-in acquisition, we had no access to the team until after the acquisition was done. And what we found was there were some really big leadership dysfunctions and communication dysfunctions going on within the team. And the team was really pretty burned out. So we've had to do a lot of repair work.
So I've lost my train of thought here briefly. So that's interesting that the changes are going to be present. And I guess, Jay, were you able to get the employee base comfortable that the changes that were coming were for the better and they weren't in opposition to them? To make sure that the employees weren't in opposition to the changes that were coming because you knew that they were for the better.
I mean, it's hard. I mean, it's difficult, and I think, we took the approach, notwithstanding my earlier comments, but we did not make a lot of changes quickly, and we did that consciously, and so, it wasn't like we were ripping the Band-Aid off in the first 3 months. I mean, it happened over time, and I think it's the easy stuff early to build trust with the employees. I mean, it's just simple stuff like doing what you say you're going to do. I mean, it's not complicated. We did have the benefit in a lot of cases where our tuck-ins were geographic extensions of our existing business, and so the folks going into that particular office, for example, were actually still pretty distinct from the rest of our business, and I think that in some ways it's a challenge because it's harder to integrate them into the overall culture of the company, but in some ways it shielded some of the changes that were happening, and we could be more, more deliberate about that specific location. So, not to put Mark on the spot, but I think Mark was really good about culture and integrating, so he's probably got a great answer to this.
Since my name has been invoked, I actually would take the opposite position. So we became better at it, but in the early days, we made the mistake that, I don't know, you're sort of alluding to, Jay, and I've heard others say this too, that we were, I think, a little too timid to take the right steps with integration. So we would say things like, really not much is going to change, and if it's going to change, it's going to be over time. So, I mean, in the most draconian scenario, you can make an informed decision about whether you want to be here when those changes go into effect. And after we did that a few times, we just realized we were making our lives and their lives much more difficult than they needed to be. So we pretty aggressively moved toward rather complete integration quickly and systematically, and for us, it began and ended with communication. So we felt like if we clearly communicated, there might still be fallout, but at least we felt like we were clear with everyone about our intentions.
If there were employees that were clearly not going to be following the changes or were not necessarily going to be a good fit, how quickly were you able to identify them, and any war stories?
War stories. Does anybody have a great one before I just start? Okay. So for us, there were really two distinct layers of people. There would be sort of manager types, and in our business, frontline employees, which were teachers. And this may sound counterintuitive, but for us, the teacher was the one we really needed to retain. So it was less problematic if we were to turn over management than a really great teacher. So we'd go to pretty great lengths to ensure that the really beloved teachers kind of got a warm hug from us throughout the process. And I'm gonna pause here because I can't think of a good war story, and I'm sure someone else. By the way, that makes it sound like we never made mistakes. We made a ton of mistakes. I just don't have a good one off the top of my head.
No, that's fair. Shifting gears a little bit, Mike, so you had the opportunity for acquisitive growth, but you chose to go the organic route. Can you walk us through your thought process there?
Sure. Well, a choice is I guess it was a choice at some point, but in our space, acquisitive growth does make sense because Attainia is providing solutions into large IDNs, and if you think about it, there's only 2,300 of them in the country, and about 900 that matter. So you're working in a field where the total number of logos that you can possibly ever have is 800-900. The only way to grow your business behind it is to increase your share of wallet. In other words, sell more stuff and charge more money for it. To sell more stuff, you're either going to build it or you're going to buy it. So the acquisition, the idea of finding a small acquisition was always there and was always present at our board meetings, but typically it fell as topic number 4 because topics number 1 and 2 were product and sales. A couple of things people mentioned that I want to touch on. The key 2 things that I think already been discussed are number 1 is culture and number 2 is capital allocation. So in terms of culture, when you buy a business, your first business, the platform, chances are the culture there is not what you'd like it to be. In our case, we bought a lifestyle business that was operated by 2 folks who were not encouraging any growth whatsoever because they were paying themselves nice dividend distributions. And on top of that, the business was virtual. So you have a double whammy. Nobody shows up to the office, and it's a lifestyle business. So we were spending a lot of time, I have nothing against virtual businesses and working remotely, but it works great when you have the right culture and the right processes in place. It works terribly, and it's really hard to change that when you have a lifestyle type of a culture and you don't see people face to face. So we spent a lot of time at the beginning to change the culture of our business, let alone trying to integrate and match what we had in terms of the way Attainia operated with a potential acquisition. So culture is huge in that decision. Number 2 is capital allocation. With organic growth, you have a lot of unknowns. You can build a model. You can say, hey, I need to invest in sales and marketing or sales organization. I need to hire this many people. Here's their payroll and bonuses and benefits and try to estimate that. But in reality, you're going to make hiring mistakes. If you're really good, 50% of your hires are going to work out. If you're okay, it's going to be the percentage is even less. So whatever you estimated, you're going to need to invest, whether it's in your sales organization or, on top of that, in our case, a product improvement. You should multiply it probably by 2 to get closer to the right answer. And that 2 could easily turn to 2.5. So there is uncertainty in that capital allocation scenario. With the acquisition, it's a little more straightforward. They went through all these uncertainty. They took the risks. They got to a certain revenue point, and now you're buying that revenue. In our case, it's more revenue than EBITDA because software businesses are valued more on the sales side. But to get back to your question, Mike, we inherited a business that had a lot of technology debt and had a missing middle management team. So in terms of decisions, we decided to fix those things. And once you're on a certain path of capital allocation, it's really hard to get off that path, especially when the job is not done. And the concept of sunk cost doesn't really, when you're an operator and you're in the midst of running a business, you don't really think, I just spent $2 million on my software rewrite. Let me just pause that and buy a couple of new products. That just doesn't happen in reality. So that's really what the decision, the thought process was. We needed to fix those things. We needed to fix technology debt, and the capital that was available to the business and all the free cash flow that the business was generating went towards changing the culture, hiring the middle management team, and making improvements to the existing product rather than pursuing acquisitions.
Was your board fully behind all those decisions along the way, or did you have to do some political maneuvering to make sure that you could stay on that path?
That's a great question. Actually, in fact, what happened was we started down the path of investing capital in rewriting the product before we even closed the deal. It was so obvious in the diligence process that this is a must-do for the business after we acquire it. We already retained resources while we were still working through the share purchase agreement before the deal was closed. We already were on the path to put capital to work towards that path versus putting capital towards acquisitions. So it was kind of predetermined by the board. It was actually, we penned the agreement to hire a firm at the offices of my largest LP. So it was kind of, we were on a glide path to spend money that way.
So one last question before we open it up to the floor. Steve and Ryan, from your perspective, are there certain industries that lend themselves to an acquisitive growth strategy better than other industries, or is this a strategy that can be applied across the board?
All right. No, I mean, I think, listen, for our industry, it's a very fragmented space, and certainly you've got to have a lot of opportunities if you're going to really aggressively go after a buy and build strategy. So I think it definitely varies, but I think it's possible in a lot of spaces. There's for all the big household names that are in industries that are very consolidated. There's probably half a dozen or more industries that are evolving, new industries, or just still fragmented but really old industries like what we're in. So I think it's a pretty widespread opportunity.
Ryan, any thoughts?
I agree. I think it's a pretty widespread opportunity, and I think it ultimately comes down to your preferences and the type of business that you're looking to build, and what that path is going to look like. Our industry is incredibly fragmented, and there's tons and tons of acquisition opportunities out there. So that's a very clear path, and there's also a very clear path to value creation through the acquisitions by creating that infrastructure, scalable systems and processes, economies of scale. So for us, the thesis is around value creation. Otherwise, we're just buying up more things to manage.
Thank you. Should we open it up to the floor?
Where's the first one? You just-
I just have a question. How do you typically fund the
It's a question about funding.
So I think the question was sources of funding for acquisitions. Is that, yeah. So I think most desirably debt, of course. And in our case, we were able to finance all of our acquisitions with debt and operating cash flows. We never brought in any additional equity.
Yep, same for me.
We took a little different approach. We knew we were going to be growing through acquisition, and we didn't want banks to slow us down early on in the acquisition process. So we went all equity on the original deal and raised committed capital out of the gate to fund the early acquisitions. And the plan for us is to transition as quickly as possible once we've got some scale over to debt and cash flow for funding future growth.
I mean, I think ours was, when we started, we were still in the housing downturn. Most of our industry had been cut by about 2/3 in terms of its revenue. So candidly, we were looking for money anywhere we could find it to put the first deal together. It came from a combination on the equity side. It was the founding team, as well as just kind of a real classic friends and family kind of capital raise. We put together a debt package with the lender of the target company that we were acquiring, and that we ended up buying the real estate as well, which was not something from a capital planning and capital allocation process. That was not something we wanted to do, but really at the time, all the value of that business was really in the real estate, and it was really the only way to get the deal done. As we evolved, we raised more equity from larger individuals and family offices, continued to grow our banking group, and eventually had a syndicate. And then 2 years ago, we shifted gears on the equity side and partnered with a private equity firm that owns the majority of the company now.
So, Mark and Jay, you both mentioned that during your process, you didn't initially envision doing acquisitions as a growth strategy, and you kind of came into it over time. Was that something that, acquisition fell into your lap? Was it an imperative from the board? How did you actually get to that stage where you decided, I'm going to dedicate some percentage of my time to aggressively growing via acquisition as opposed to, one-offs that came to you?
So, good question, Russ. For us, we bought a business that was relatively low growing. It did produce a lot of cash, but it was also a smaller TAM than we thought. And so we got some things right in diligence, and some things weren't quite as good as we thought. And so we were just honestly thinking about how are we going to grow our business. And the pond and lake management industry jumped out to us as a logical service line extension to what we were already doing for a lot of reasons. It was related, similar regulatory environment, similar customers. And so that's why we did the first acquisition. And even at that time, we did not plan on doing a lot of acquisitions. But we paid a price that was very interesting. That business's competitor then called us. We were able to buy that for a very reasonable multiple. And so we then sort of realized, as we were just thinking about the opportunity set in our industry, this is a really attractive way to deploy capital and allocate capital. And that's sort of really year 3, 4, where it became we can buy a lot of these and where we try to scale up the program.
So, as with most things, Jay and Jason were more thoughtful than I. But our pivot to acquisitions really derived from, I think, a diligence oversight on my part. And specifically, we thought new schools, kind of opening new schools, was going to cost X. And after we opened a couple, it averaged to be more like 3X. And so from a capital efficiency standpoint, we started thinking, hey, I wonder if there's maybe a better way to do this. And that resulted in the pivot to acquisitions.
This question for Steve. I'm curious to know from the 20+ acquisition you did, do you see a pattern when you compare pre-acquisition, the synergy show on paper, and post-acquisition synergy actually realized?
Yeah, so synergies, that's kind of an interesting area for us. I will tell you candidly that, first of all, what you need to know about our model is that we are violently decentralized in our operations. So we've got about 3,000 employees. We've got 35 at our headquarters. We're very defined about what we do in a consolidated fashion, and that's all kind of support, things that are away from the customer, more transaction-oriented. Anything that's customer-facing, we keep as close to the local operations as we can. There's a lot of reasons for that. It'd be a longer discussion that you guys want to hear. But so what that means for us is that, particularly in the early days, synergy was not about, oh, we're going to cut 50 basis points out of cost of goods, or we're going to do this, we're going to do that. Synergy was really about creating a culture where previously independent and mostly family-owned businesses could come together and collaborate and learn from each other and share best practices. And so, it wasn't something that you put on paper in the deal process. I think as we've evolved, naturally, we now have 23 businesses around the country. They fit into kind of 4 different segments. And so there is more that we can offer of a concrete basis to really drive synergy. And so now, we typically are looking at buying programs that we already have in place that we can offer to kind of our member companies, our operating companies locally. But there again, we're still looking at 50, 75 basis points kind of on a deal. But for our business, it's a very low margin business. That kind of change can have some very real value creation for us.
I just want to say, in the small business, when you're doing small tuck-ins, there are more likely to be reverse synergies than there are positive synergies. Because most of these businesses have no infrastructure. They often don't have health care benefits. They may not have a 401k plan. And so we very often built in reverse synergies, additional costs.
This question is for Mark, Jay, and Mike. So working with your search fund investor group, was there any ever hesitation from the investors around this strategy? And if so, how did you convince them?
So I would characterize what we did in the earlier days of acquisition not so much as pivoting wholesale toward a buy and build strategy. So we were really augmenting our organic growth, and we just evaluated each acquisition in isolation. So I just wouldn't characterize it as a complete shift in strategy. So long as they were capital efficient, I think our board was open-minded, and we were just pretty dogmatic about being disciplined from a valuation standpoint.
Yeah, our board and investor group was highly supportive of the strategy. I mean, we didn't do it until 2 years into the deal, and I do think that's important. But it became I think, a compelling thesis. And I just think in general, there's more openness to this type of strategy now from the search fund investing community than there probably was 10 years ago. Agree with that?
Totally.
I think in our case, we were also in a place where our organic growth was not low enough for the board to start thinking about what do we do about this from the inorganic point of view. It was just high enough for us to keep pursuing efforts in that way and improving management, improving processes. So when you have double-digit growth, even though it's a low double-digit growth, you're doing okay, and especially in a enterprise B2B space where sales cycles are long, and there is a number of you have 5 different stakeholders on average to convince to get a deal closed. When you have that type of growth, it's not phenomenal. Obviously, you want to grow 20-30% per year, but at the same time, it's not so low that the board will go and say, guys, we need to do something. We're stagnating. The business is not growing. We need to pursue an acquisition. And as I said earlier, also all of this happening in a context of significant technology debt with which we bought the business. There's always this kind of, which is not, it's not untrue. It's not unrealistic, but there is a aspiration that once the technology debt is taken care of, the sales growth is going to accelerate significantly, and that's the path to creating a larger revenue base that's right around the corner versus going down the path of proactively evaluating targets and going through acquisition processes. With many of them can take, if not, you're lucky if they take many months, but most likely years.
Somebody mentioned the culture of acquisition within the company. I'm curious, how much did you put out a culture of acquisition outside of the company, a brand of, hey, we're buying stuff up, or did you try to actively not do that?
I think it's a great question. We were very conscious about having every seller we bought a business from being a reference for us, and that was really important to us.
Yeah, so we also tried to very much make clear to the marketplace that we were buyers, and as Jay said, leveraging business owners that you've bought from as references is about the most powerful thing you can do to set yourself apart.
I mean, we've definitely not been shy about, in our industry, letting people know that we want to acquire. I liked what was said a minute ago about former sellers, being a reference for you as well. We've really focused on that in terms of offering up past sellers references, setting up conversations to let them know, let a potential new seller know what an old seller's experience was. I think that's really valuable.
We're very open in our core markets about our desire to grow through acquisition, but we also face a lot of fear in our industry about the consolidation that's going on. There's a lot of the dental associations are teaming up and going against what's considered corporate practice of dentistry, and there's a lot of fear about the intentions and implications of corporate ownership in the dental world. So we're very, very careful about how we present ourselves to the market and what our value add is going to be with the practices and why we're growing through acquisition and what we do with the acquisitions. So we have to approach it very delicately, but we do want to make it known, and we also feel very, very strongly about the sellers being references for us and managing those relationships really, really closely.
Right here. Yeah. Mike, you mentioned changing cultures. What were some of the drivers or the levers that you pulled to go ahead and change change culture within the company, given that it was remote?
What were some of the drivers to change culture?
Yeah.
Well,
or the levers that you pulled. How did you go ahead and change culture without, it was a remote company, right? So
right.
With a software business, assuming a fair number of developers who were probably in high demand. So if you go ahead and start changing culture abruptly, there's a chance that you could start seeing an employee exit in mass, especially when developers are in high demand?
Oh, I don't think it's a chance. I think
Yeah,
it's
okay.
I think it's almost a certainty. Well, they have to unpack what culture is, which is, a set of beliefs that are shared by the group of people, and then that set of beliefs is driving then behavior, which then drives the way you approach things. So, well, you have to, you start with communication, right? And you start with saying, what I think has been actually mentioned before, saying something and then doing exactly what you said. So, but in order for your communication to be effective, obviously you have to have somebody to communicate to. So we started asking people gently to start coming into the office so they can get to know each other and get to know the new management team. So that was part of it. Another part of it is when you have a small business, every new person that comes into the business is changing the culture in one way or the other. And you want that person who you're bringing in to change the culture in a direction that you're seeking to change it. So part of it was through asking people to basically making it a more on-prem company versus a virtual company. Because a lot of our, in our case, a lot of our employees, they were physically in Phoenix or in Scottsdale. They just didn't show up to work because that was the culture. It's not like they were somewhere in Eastern Europe. No, they were just sitting at home. So for us, it's just asking folks to come in maybe 1 or 2 more days a week so they can start buying into what we're trying to do, and then bringing in new blood and bringing in people who will promote the culture that you want to build. But at the end, I think you're hinting at something that. And this is a whole other topic of discussion that people can spend hours talking about, but actually I would like to, if you guys can tell me, especially the guys who bought a company through a search fund, how many of the original employees are still there? In our case, it's, we have a handful of original folks who embraced the culture, but the vast majority, I would say 80% or more of the people who work at Attainia today were not there when we bought the business.
I'll chime in on that. We think about retention in terms of good retention and bad retention or turnover. So some turnover is good and healthy, and we want to get rid of the rotten apples before they sour the batch. So what we're doing around culture is just, one, follow through, do what you say you're going to do, and make it clear to all why you're doing it. Communication is a big issue in our industry, and I think there's a lot of bad leadership and poor communication. So people are really craving communication. They're really craving to be a part of something. So I think in our situation, there's generally a lack of culture, and people are craving it. So providing it through communication, people love to see that we not just post our core values, but we talk about them, we make decisions with them, we hire and fire by them, and those are the things that start to drive behaviors and make people, make decisions for specific reasons that are aligned with our core values. And for me, that's what really starts to drive and create culture.
We have time for one more.
Hi, can you talk about the mix of acquisitions that you've pursued in terms of geographic expansion, what the motivation behind the acquisition, geographic expansion / sales expansion, or product and service expansion? And I'm particularly interested for those of you who overlaid a new product or service, how that may have been different from, in the integration perspective, from the geographic sales expansion.
So as far as kind of the kinds of deals we pursued, as background, I mean, our industry is very cyclical. And so, and it's also historically very segmented, meaning, from a construction standpoint, this company grew up kind of supplying single-family homes. This company grew up doing commercial, and so on. So as we were coming out of the housing downturn, and the founding team that started Kodiak was in their 20s and 30s, we wanted to build a business that could really more successfully migrate through industry ups and downs, those cyclical ups and downs. So our acquisition process was very targeted from a geographic standpoint in terms of being in several different markets, but typically markets that had kind of a very long-term upward demographic bias. So, for example, Florida, Texas, Colorado are our three biggest states today, and probably always will be, because there's just a natural demographic trend that lends itself to riding through ups and downs when, in general, the state is growing, the population's growing, which means you need more, more businesses, you need more schools, you need more homes, and so then the second thing for us was about that type of construction that we would supply. And so we acquired businesses really proactively and looked for businesses to kind of encourage more of a mix. So instead of just being very, single-family home building focused, we looked for companies that really serve that multifamily market. We looked for companies that serve the commercial market, looked for companies that did more infrastructure project supply. And so we've really kind of over time tried to construct the portfolio to have both of those mixes so that over a long term, we could ride the ups and downs a little bit more successfully than maybe a really homogeneous kind of company.
We're very geographically focused in our acquisitions right now. We want, while we're integrating and learning all the systems and processes that we need to have smooth integration, we want to be able to get in the car and drive to a practice within a couple of hours if there's problems going on and we need to be face-to-face with someone. So while we're working out those systems and processes around integration, we're very, very geographically focused and don't want to get too far out of a drivable range. That will likely change for us in the next year as we feel more confident in our integration processes and systems. But we're also very specific about the markets that we want to be in and why we're going into the markets. For us, it's all about our delivery model and being able to provide a great patient experience as well as a great team experience. And for us, that comes out of larger centers where we've got multiple doctors and multiple specialties under one roof. That allows us to really drive the culture of the team and provide for the patients and have them treated in a way that they want to be treated.
Great. Thank you so much. How about a round of applause for these guys?